I'm looking to open a neutral corn play that is a short strangle. So step number one, I want to wait for January 12th. Why? Because there's a USDA WASDE report. It stands for the World Agriculture Supply and Demand Estimations. Basically, this report is the first one of the year, and it shows us what kind of export sales we had in the year of 2025. Usually, it can move the price up or down, or move volatility up or down. Currently, the volatility for corn is pretty good. So step number two will be for me to check if the volatility is still relatively high, and if it is, I'm probably going to focus on the 420-470 short strangle, around 45 days to expiration, and I'm going to show you exactly what it looks like on the graph in a second. Now, price might move, so these numbers might change, probably will, but for now, this is what I'm looking at. And also the DT also will change a little bit, obviously, because it's going to be in just a few days. So step number four will be to take profit at 50% of credit once I open the position. Stop loss is also at 50% of credit. And I'm looking to collect about 4% of my total capital in credit. And for those who don't know, my name is Eli. I'm a professional option trader. I manage just over $9 million of family capital. So let's look firstly at the CVOL, which is the commodity volatility index for corn and for other futures, obviously. So the 3-month CVOL, which is what I'm looking at usually, is relatively pretty high. It's been creeping out creeping up slowly, and it's relatively high, which is always a good sign, especially for a short strangle. Now, for the corn position itself, this is the expiration. It's the March expiration. This is basically the range that we will get. You can see prices have been moving quite sideways for a few months at this point, which is a really good sign for us. Fundamentals also don't have any significant catalyst to push the price up or down. The skew is basically non-existent. And basically, the skew just means that calls will be relatively more expensive than the puts. So here, it's basically kind of the same, which is to be expected when price is moving sideways, right? So for example, for gold right now, the skew is to the upside. So calls are way more expensive than the puts, right? The price obviously has been surging up more and more. So market makers are kind of pricing, are giving more risk premium to the call side. So here with corn, it's kind of equal. So if you take a look at the expiration that is closest to 45 days, which is where we get the best theta, it's this one, February, March, and it's always going to be the OZC, not the OCD. And there's a few reasons, but mostly, as you can see, it's way more liquid. Now, the market is closed right now as I'm making this video, so the numbers are not exact, but this is kind of a rough estimate of what we can expect to get. And maybe I'm going to be going to the next cycle up if the premiums are not going to be quite enough here, but we'll see. It depends on what's going to happen. So for just one contract, you get about $219 in credit, probably a bit more. With interactive, it shows you the bid credit that you can get. So this is not the mid price credit that you'll be getting. At the same time, I'm looking to collect about 4% of my account in credit. So let's say I have a $100,000 account. So we're looking at potentially, let's try 16 contracts, because we're looking to collect about $4,000. So maybe 18 contracts. Yeah, so 18 contracts is just enough per every $100,000 to collect the amount that I'm looking at. We have a pretty good theta of $130. Now again, these numbers are absolutely going to change just because the price is going to move. Things are going to change, and hopefully, as long as volatility is going to stay high, we can figure out the strikes, the ranges, and the obviously the premium. Another big giveaway if the position is probably going to be a good position if its margin requirements are relatively small for grains specifically, which it is. It just means the broker, the market makers, they don't expect much going on. So if you look at other grains, for example, if we just take a look at soybean, for example, it's been having up and down swings like crazy. So the picture there is completely different. There's a skew. Right now, I think it's still to the call side. I haven't checked actually, but it's quite a bit different. But here we have basically no skew. We have good credit for a very good amount of margin. Then this is per $100,000 account, or per every $100,000 in capital. So this is kind of my plan, what I'm looking at. Profits at 50% and stop loss at 50% as well. We have a pretty big theta, so this position should be profitable quite quickly. Now, if volatility drops, if CVOL drops, then we are going to be profiting much quicker on this position, which is again the plan. As after the January 12th report, there is really nothing that we can expect as a major report or a major thing that can happen for the most part. So this is it for this video. Thank you so much for watching. If you have any questions, let me know. I'll keep you posted of, again, my thoughts, my plans as best I can, and hopefully you find it useful and you end up making money based on my maybe analysis or my approach to trading overall. Now, thank you again, and I will catch you in the next one.